So this past Wednesday, everybody pretty much covered the same thing, talking about the feds are holding rates and there's actually maybe a rate hike that could be coming in the future. But one big thing people were not talking about that I think is the biggest thing about this whole meeting is the new chair said that there basically could be an inflation number we've all been reacting to that might be the actual wrong number. Today we're going to break down exactly what that number is and why it's different, why that numbers matters to you at all, and more importantly, what the hell Kevin Warsh actually said during these Fed meetings. Y'all know the vibe, man. It's your boy D Wall, co-creator at ThinkinGenWealth. Let's get straight into it. All right. So boom, Kevin Warsh. We had our FOMC meeting this past week, and the new Fed chair, Kevin Warsh, didn't just hold rates. He rolled out an actual 5 task force to essentially overhaul the whole Fed. All right. Now, one of these 5 task force is specifically looking at the data sources the Feds use to measure the economy. This is all during this June 17th press conference, all right? Now, in Kevin's own words, he said he wants to learn new data sources in the private sector, new analytic techniques, and he leans towards trim mean inflation over the headline number. All right, we're going to go over exactly what trimmed mean inflation is and how that compares to the headline number in a minute. But essentially, what he's saying in simple terms, he's like, yo, the way we track inflation is mad old and wild crazy. We need a better way that tracks more current data because it's super lag, the data that they look at now, right? Now, why is that a big deal? The feds have been above their 2% target for the past 5 years. 2% target means that the feds have a 2% rule for inflation. Their goal is to get inflation to 2% at all times. Where that rule comes from, it comes from Switzerland. Where does Switzerland get from? They made it up. So the whole 2% rule is some nonsense as well. But I digress. But the 2% rule for 5 years has been pretty much blown off due to transitory cause. All right. The previous FOMC committee has been saying that inflation is in a transitionary period, and that's causing a delay in the lowering of inflation. Now, this current Fed chair is auditing all of that and being like, nah, let's actually see what they're talking about, right? So, without further ado, let me share my screen real quick so we can go over these numbers that I'm talking about. Boom. So we here, right? So exactly what's going on, right? So we have multiple numbers of inflation that the economy uses to track, right? You have your headline inflation, which counts for your headline CPI. And this number is pretty much the number one number on every headline. It's at a 3-year high, and it's at over 60% because of the energy spike when it comes to the Iran war. Okay. So this is the overall headline inflation that us as consumers are going to see on CNBC, CNN, all that, right? Then we have core CPI, all right? Core CPI is essentially the inflation that we see, but it excludes food and energy, all right? And this number is currently at 2.9%, all right? And that's exactly what essentially the feds are talking about when it comes to that 2%, that 2% rule, okay? Now we have trim mean CPI. Now, what the hell is this, right? Trim mean CPI is Warsh's specific preferred measure of tracking inflation. All right. So it throws out all the big movers in inflation. It throws out food, energy, anything in a category that's super volatile within the inflation report. Trimmed mean CPI takes that out so that way they can see what the actual baseline of inflation looks like right now. All right. And right now, that's sitting relatively the same as core CPI at 2.91%. Now, the big thing that I want to focus on is Truflation. All right. Now, Truflation is pretty much a software that pulls over 13 million plus daily price points, and all in the private sector to give us a read of what inflation looks like right now, right this second. No delays, no housing, nothing. It tracks everything right now at this second, and it gives us the data for it. And if you look at Truflation, we're actually sitting below the 2% rule. We're actually sitting at 1.85%, which is essentially deflationary. Okay. So why do these numbers disagree? Okay. The headline CPI, it's super lagged and it's energy heavy. We talked about that and how the Iran war caused it to run up so much due to oil spiking. The trim mean and the real time trackers, they strip all of that noise and read cooler. None of these numbers I would say is fake. All right. They're all actual numbers, but they answer the question on how fast are prices rising. The thing is, though, they have different timing, different weights, and different baskets overall as to what they're tracking when it comes to inflation. They just have different pieces. CPI, PCE is all super delayed. Truflation and trimmed mean CPI is much more current to accurate data. All right. That's the whole story. And the new chair, Kevin Warsh, he's assigned these 5 task force to identify what the best data source would be for all of these types of pieces of inflation. So that way the feds can make the best informed decision with the best data possible. All right. That's all the context of that, y'all. All right. Now, overall, at the end of the day, we want the Fed to do this. We want them to have the best data possible because we don't want anybody playing with our bread and our bills. Think about it. There's a lot of people out there who have high credit card debt that have to pay a lot on their minimum balance due to the high interest rates. If there's eventually a rate cut, that could save the people a couple of dollars. But not just for those people, we want to focus on having the best data. We also want to be ahead of the curve rather than behind the curve. The Fed has always been behind the curve because they're looking at old data. If we can get ahead of it by looking at current data, I think that will give us our best benefit of the doubt. Okay. Now, what this all means for your bread, right? What does this mean for my money, my dollars right now? For me, right now, essentially, what it really means for you is we're most likely not going to get a rate cut this year if these task force don't align on their tasks as soon as possible for until the end of the year. I think it's going to take time for them to find the best reasoning, best data, best software to track all this stuff. So realistically, I don't expect a rate cut this year. And since we're not expecting that and CPI is running so high, remember, like I said, the rate cuts affect everything as far as short-term interest, right? So that means credit card debt, credit card APRs, and that means auto loan, personal loans, etc. All the interest rate cuts that the feds can do affect those specific pieces. Credit card interest rates, auto loan and personal loan interest rates, right? So with the headline CPI running up so much off of energy and the underlying trend of truflation, things like that running cooler, the Fed, since they're seeing the headline piece, could hold rates higher than the real economy needs. And that's exactly what the difference is between truflation and CPI inflation or PCE, whatever you want to look at. And we're essentially paying that for every variable rate debt that we have, specifically credit cards. All right. So what we can do is measure the trend. All right. So look into these things. And you don't have to be a full-on expert. Just know if you see a big gap where truflation is super low and headline inflation is super high, that can tell you where future inflation can go. Because since headline CPI is so delayed and truflation is current, Truflation essentially is telling us where headline CPI will be going in the future. And that tells you what you could do as far as your debt, managing your finances, etc. 3 of the best things I would say would be the best things to do that I would personally do is first, pay down your high revolving debt as much as possible. Use things called the snowball method, which is essentially when you have, let's say, 5 credit cards and one of them has the highest balance and one of them has the lowest balance. What you do is pay off the card with the lowest balance and focus all your income towards that debt and pay the minimum on the other cards until you pay off the card with the lowest balance. Then you scale up to the second card. You focus all your income towards that debt until you pay that off while paying the minimum balance on the other ones. Then you scale up and up until you're fully done. Do that so that way you're saving money on interest in case they evidently do hike rates. You don't want that. Second, you want to make sure you have your 3 to month savings, 3 to months of expenses saved, 3 to 6 months of expenses saved up. So that way, God forbid, anything happens, you don't have to get back into debt. You can use cash to cover any expenses that may come up. And third, like I said before, stay aware of the trend. Look into the inflation numbers to dictate where you think inflation is going to go. So that way you know if you're ahead of the curve or behind the curve when it comes to managing your debt. All right. So overall, y'all, to recap, the Fed is hinting at a hike, but the bigger story is the new Fed chair is essentially auditing how us as inflation is being tracked. All right. He's looking at numbers such as trimmed mean CPI, which is essentially all the volatile pieces of inflation taken out. So you can see the base of it. And he's looking at things like Truflation, which tracks the overall current right now inflation numbers rather than headline CPI, which tracks everything from 6 months ago to a year ago. It's super delayed. All right. The official CPI says 4. The real time Truflation numbers that we see, we're sitting at 1.8%, which is below the 2% that the feds are looking for. So the honest answer is really depending on how you count which one you prefer, but this is exactly why Kevin Warsh is doing everything he's doing, is to make sure that whatever the data is, we have all of it as most accurate and current as possible. All right. Remember, y'all, this is for educational purposes only. This is not financial advice. If y'all got any questions on anything, make sure you let us know in the comments below. It's D War. I'm out of here.